Well, time to move on then. There was some weakness that we saw in Sundaram Finance performance for Q4. That's if you compare it with its peers. There was a decline in net interest margins, although there was some improvement in the asset quality. Mr. Rajiv C Lochan, the managing director at the company, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, for the past quarter, dispersals were a bit of a degrowth. AUM growth was a little bit soft. And NIMs, there was a mild compression on a sequential basis, though you had hinted at that in the past. Give us an outlook from here on. Will dispersals pick up? And what is the guidance you can give us for FY24, both on the AUM growth side as well as on the NIMs? Please go ahead, sir.
Good morning, Nigel. Thanks for having us on the show. At the outset, after 3 years of quite a challenging period for the economy, we've had our first full year of uninterrupted operations like most of the economy. And I would say this has been a year of resurgence. The fourth quarter in particular has actually been quite strong. I'm not sure I fully agree with some of the characterization that you have just made. We've had the highest disbursements ever in our history. Overall, AUM has grown 17% after relatively flattish performance over the last few years. Asset quality is at a near all-time best performance of 1.66% gross stage 3 and 0.86% net stage 3. And profits have grown 20+%. We've had our first 1,000+ year net profit year in our history, adjusted for one-time money. So for us, it's been quite a satisfying year. And the fourth quarter has actually been a pretty strong quarter in our assessment. So I'd love to understand, specifically what you're looking for by way of...
Mr. Lochan, we're just comparing it with a couple of peers. If you compare it with Chola's and Shriram Transport as well, in comparison, so we get that point that the numbers are fairly satisfactory and fairly good. But if we just put up, comparison, that's the only reason that we say it could be a little bit softish in comparison to them. But you obviously have your reasons, so you could run us through that. And you could give us an outlook from here on as well on this good performance as per you. What can you guide?
Let's do the peer comparison. And I would just request all of you to do a peer comparison with a balanced view. You've got to look at growth and not only growth. You've also got to look at asset quality. You've also got to look at profitability and operating margins. And the easiest way to look at the balance across these three is to look at the return on assets. And if you look at the return on assets, we've a closed return on assets of close to 2.9%. Our peers, any of the names that you picked are lower than where we are. So to our mind, at the end of the day, that return on asset metric is what we're optimizing for. There is a set of net interest margin fee income you can earn, which gives you the revenue. There's a set of operating costs that you work with, and then there's asset quality that you have to drive. Balancing these three is what I think every institution attempts to do. When one focuses on one particular metric a little bit more than others, it then gives a different characterization. As you know, and we've said many times in the past, we are marathon runners, right? So we are running a marathon, which is a steady, systematic, consistent pace that we set. We'd like to strike a good balance between growth, asset quality, and profitability. And I think that's what we are doing quite systematically.
All right. No, absolutely. Point taken. Very well explained as well. So the sum total of all of it will reflect on the return on assets, and point taken there, Rajiv. Good morning. Now, could you tell us what is the incremental cost of funds for you at the moment? How do you see that panning out into FY24?
So, Prashant, as you know, the last year we've seen a 250 basis point increase overall in the repo rate. That is obviously transmitted for someone like us who relies on the capital markets almost immediately. And so we've seen nearly 120, 130 basis point increase in our cost of borrowings. We've tried to balance that out by transmitting the rates, by focusing on the right customer segments to price the risk well, and to get the right balance across the different asset classes that we work with. Some are sort of low-yielding assets, others are high-yielding assets, so we need to get the right portfolio mix. Net of that, I think our spreads are down about 19 basis points, which I think is expected and back to pre-COVID levels. As all metrics have moved to pre-COVID levels, the spreads are also moving to pre-COVID levels. And as I mentioned in your show in the past, I think for the system, we should begin to see that over the next 4 to 6 quarters. Looking ahead, we do see a relatively stable interest rate regime. I think inflation is sort of somewhat under control, it looks like. That's what I don't want to jinx it. And therefore, the posture that the Reserve Bank has articulated seems to be one of sort of cautious optimism that inflation will come under control, and therefore interest rate hikes may not happen. That said, I think global macro tends to be quite complicated. I think US inflation remains quite firm at 5+%. I think their personal consumption was a little bit of a surprise, growing quite nicely month on month. So I don't know how the Fed is going to react, and therefore the reaction of our regulators to that is something that we have to wait and watch. But we expect a relatively sort of calmer and a quieter front on the interest rate and therefore cost of borrowings. So we'll see how this year pans out.
Okay. So do you want to give us any kind of, outlook as far as the net interest margins is concerned? Once again, coming back to peer comparison, and I get your point entirely that, it doesn't make sense to compare on one parameter. But even on net interest margins, at a time when you have seen your margins decline, other peers have seen it, your peers have seen it rise. Just trying to understand, sub 5% currently, what is the outlook for FY24?
Morning, Sonia. As you know, and we've mentioned multiple times, we don't give a guidance or an outlook. I think what we would like to ensure is consistency in what we've created post-COVID over this past year in terms of that consistency in growth, quality, and profitability. I think the simplest way for us to ensure that we deliver that is to transmit the cost of borrowing as best as possible, price the risk that we're underwriting as best as possible, look at the right customer segment mix in each asset class we operate, and get the right asset mix across all the asset classes that we're operating. If we do that, we think we will maintain a historic, long-term, steady sort of cost spreads in the 4.5% to 5% range, which is what we've operated over the last 15 to 20 years. We don't look quarter to quarter and make comparisons, right? So long-term, that's where I think we'd like to ensure that our spreads are.
All right. Mr. Lochan, the market is full of opinions, and good to hear your clarification as well on that, and we take that on board. But there's no debate on the Sundaram Home Finance part of the business. That has done very, very well. How do you see that shape up from here on in terms of an AUM growth? Or you could give us a couple of targets out there?
Nigel, again, I think it's been the new management team there has had a first full year of operating as a team, and we're seeing the results of that team executing very well. As you know, we've doubled down a lot more in southern India, tier 3, tier 4 markets, where housing demand continues to remain quite robust. There's a fair bit of technology, digital, and data that team has brought into bear. And you're seeing the combination of sort of focus on growth and diversification, as well as productivity and efficiency beginning to play out. We expect that to continue. I mean, housing has a long runway in India, and we'll again expect a similar kind of GQP balance that organization will also strike.
Sure. Okay, we will let you go on that note. Thanks a lot for joining in, and hopefully the next time we speak, the numbers will be much better than what you've delivered this time around. That's the hope. So we'll, touch base with you again very soon. That is the management of Sundaram Finance. But let's